Most business owners form an S corporation for one simple reason. They've heard that S corps can save taxes. So they elect S corp status. They start paying themselves a salary. They start using tax strategies, hiring their kids, buying vehicles, claiming a home office, maybe even using the Augusta rule. And then they assume the tax planning is done. But here's the problem. Many business owners don't actually know whether their S corporation is saving them money. And what's even more surprising, some of the biggest opportunities and some of the biggest mistakes aren't hiding inside complicated tax strategies at all. They're hiding inside the tax return that's already been filed. Welcome to Ivy Smart Tax. Welcome to Tax Decode. Today, we're breaking down the 7 S corporation hotspots every business owner should know.
So this isn't another top 10 tax deductions video?
No, this is about understanding where S corp opportunities usually hide and where S corp mistakes usually hide.
Wait, isn't an S corporation something a lot of CPAs recommend?
In many cases, yes, but that doesn't mean it's the right choice in every situation. In fact, many business owners automatically assume that once they form an S corporation, their tax planning problems are solved. But reality is usually more complicated than that. Sometimes an S corporation is the right answer. Sometimes it isn't.
So the first step isn't optimizing an S corporation?
Exactly. A lot of people start by asking, how can I make my S corporation save more taxes? But the real question they should ask first is, should I even be using an S corporation in the first place? Because if the entity structure itself isn't the right fit, many of the tax planning strategies that come afterward may not work nearly as well as expected. Now let's talk about the question most business owners care about. How does an S corporation actually save taxes? Because many owners hear, S Corp can save taxes, but very few people explain how.
So an S corp doesn't automatically create tax savings?
Exactly. The savings come from how the structure is implemented. For example, sole proprietors generally pay self-employment tax on all business profits. S corporation shareholder employees may receive both wages and distributions, subject to reasonable compensation requirements. Under the right facts and circumstances, that may reduce payroll tax exposure.
That's the famous S corp savings everyone talks about.
Exactly. But the savings are not automatic. Reasonable compensation rules still apply.
So you can't just pay yourself a tiny salary and call everything else a distribution?
Correct. The goal isn't to minimize wages. The goal is to create a defensible balance between wages and distributions. Because an S corporation doesn't create savings by itself. The outcome depends on how the structure is actually implemented. This may be the most important S corp hotspot of all: reasonable compensation.
Why is it such a big deal?
Because many business owners understand that S corp savings often come from the relationship between wages and distributions, and that leads to a common question. If lower wages create more savings, why not make the salary as low as possible?
A lot of owners probably think that.
Exactly. But from the IRS perspective, the question isn't how much tax did you save? The question is the compensation reasonable?
So reasonable compensation is really a compliance issue?
Exactly. The IRS looks at the work being performed and whether the owner's compensation reasonably reflects that value. Because if you're actively running the business, those services have economic value. And that's why reasonable compensation remains one of the biggest S corp hotspots. Let's look at another hotspot many business owners have heard about: the QBI deduction, also known as the 20% business deduction.
That's the deduction people talk about when they say business owners can pay less tax, right?
Exactly. But here's what many business owners don't realize. Wages don't just affect payroll taxes. They may also affect QBI.
Wait, we've been talking about reasonable compensation. Now wages affect QBI too?
Exactly. And that's where tax planning becomes interconnected. One decision can affect multiple parts of the return.
So there's no single number that's automatically best?
Correct, because tax planning isn't about maximizing one rule. It's about balancing multiple rules at the same time. Here's something many business owners don't like hearing, but need to understand. There are situations where an S corporation may provide far less tax benefit than expected, and in some cases, the benefit may be quite limited.
Seriously? I thought S Corps were supposed to be great for tax savings.
In many situations, they can be, but not every business is the same. For example, if reasonable compensation ends up being close to total business profit, the payroll tax savings may be much smaller than many owners expect.
So becoming an S Corp doesn't automatically mean tax savings?
Exactly. An S corporation is a tool. It's not the result. What matters is whether the structure fits your situation. That's why professional planning usually starts with modeling, not assumptions. Let's talk about a hotspot that many business owners only discover after they've already missed it:
What gets missed so often?
timing. More specifically, tax planning timing. Many owners assume that as long as something is handled before the tax filing deadline, they're fine. But some tax opportunities don't work that way. One example is a PTE election, a state level tax election that may provide benefits for certain pass through business owners.
So the issue isn't usually the strategy itself?
Often it isn't. The real issue is timing. Some states require elections before year end, some require payments before year end, some require both. If you wait until tax season to discuss it, the opportunity may already be gone.
So the filing deadline and the planning deadline aren't always the same thing?
Exactly. And that's where many business owners get caught off guard. Sometimes a tax opportunity disappears not because the strategy was bad, but because the planning started too late.
Everybody loves write-offs.
Exactly. And that's why depreciation deserves attention, because many business owners have a common misunderstanding. They assume depreciation permanently eliminates tax.
Doesn't it?
Not always. In many situations, depreciation is really changing the timing of taxation, not eliminating it entirely.
What do you mean?
In simple terms, some of the tax benefit you receive today may come back into the tax calculation when the asset is sold. Depending on the type of asset, the structure of the transaction, and the surrounding facts and circumstances. That's why depreciation planning shouldn't focus only on this year's tax savings. It should also consider future consequences.
So depreciation can sometimes be more like tax deferral?
In many situations, that's a reasonable way to think about it. And that's exactly why depreciation should be viewed as part of a broader tax strategy. Let's talk about something many S corporation owners overlook. A lot of business owners pay business expenses personally, including home office expenses.
A lot of owners do that.
And that's where confusion often starts. Many owners ask, can I deduct it? But often the better question is, where should the deduction be handled?
What do you mean?
For S corporation owners, where an expense is handled can be just as important as the expense itself. That's where accountable plans may come into the conversation. When properly structured and documented, the business may reimburse certain qualifying business expenses.
So documentation matters?
Exactly. Many tax issues aren't about whether an expense exists. They're about whether the expense is in the right place and whether the documentation supports it. Let's talk about the final hotspot: late S elections.
That sounds like an administrative issue. Is it really that important?
Much more important than many people realize. A business owner forms an LLC, starts running payroll, operates as an S corporation, and then discovers years later that the S election was never properly completed.
So the owner thinks they're an S Corp, but the IRS may not see it that way?
Exactly. And the issue often isn't discovered until years later.
So is it too late at that point?
Not necessarily. In certain situations, relief may be available for late elections, but don't assume it's automatic. Facts and documentation still matter.
So you can't assume the IRS will automatically approve it.
Exactly. When most people look at an S corporation tax return, they see forms, numbers, and tax documents.
That's probably how most business owners look at it. They check whether they owe money or get a refund, then move on.
But tax planners see something very different. They see opportunities, risks, structural issues, and the connections between different decisions.
The same tax return. but a completely different perspective.
Exactly, because tax planning isn't about one number. It's about understanding how different parts of the return work together. That's why two professionals can look at the same return and identify completely different opportunities and risks. Most people see a completed tax return. A tax planner sees a system. If there's one thing I hope you take away from today's video, it's this. Many business owners think tax planning is about finding new strategies, but some of the biggest opportunities are already hiding inside the tax returns they're filing today.
So sometimes the biggest opportunity isn't a new deduction. It's discovering opportunities and risks that already exist.
Exactly. So let me leave you with one question. Of the 7 S Corp hotspots we discussed today, which one have you never reviewed? If you enjoy real-world tax cases, real tax returns, and practical tax decoding, follow Ivy Smart Tax, because some of the biggest tax opportunities are often hiding in plain sight. This video is provided for educational purposes only and should not be considered tax, legal, accounting, or financial advice. The examples discussed are simplified for educational presentation and may not reflect all relevant facts, limitations, or exceptions. Tax outcomes depend on each taxpayer's unique facts, circumstances, state laws, income levels, and business activities. Strategies discussed in this video may not be appropriate for every taxpayer and should not be implemented without evaluating your specific situation. Before making any tax, legal, or financial decision, consult with a qualified professional familiar with your circumstances.